day, everyone, and welcome to ICRA's webinar on GDP Outlook for Financial Year 2021. Our principal economist, Ms. Aditi Nair, will take you through the presentation. The webinar will be followed by a Q&A session with the participants. I now hand over the conference over to Ms. Aditi Nair.
Good afternoon, everyone. My name is Aditi Nair and I'm ICRA's principal economist. I thank you all for joining us today as this extremely challenging year draws to a close. On behalf of ICRA, I welcome you all to today's discussion on the GDP outlook for FY21, gauging the recovery in the Indian economy. I have with me two erudite panelists, Indranil Pan, Group Chief Economist, IDFC Bank, and B. Prasanna, Head Global Markets and Proprietary Trading Group, ICICI Bank. They have kindly agreed to join us today and share their insights into the Indian economy. I will now set the context before inviting our panelists to share their views. Just to recap, with the unfolding of the COVID-19 crisis and the imposition and extension of the lockdowns, Indian GDP contracted by a deep 23.9% in Q1 of FY21. This was one of the worst performances on a comparable basis amongst the large economies and fairly unsurprising in light of the stringency of the lockdown. Subsequently, Indian GDP posted a sharp recovery relative to Q1 of FY21, with a shallower than expected degrowth of 7.5% in the second quarter. However, with two consecutive quarters of contraction, the Indian economy entered into a technical recession. The big question now being pondered by economists and non-economists alike is, when will this recession end? Moving on to Q3, the festive season started later than it did in 2019, and it was expected to be robust, benefiting from healthy farm sector demand, pent-up demand, as well as a real revival in urban sentiment and confidence. However, the consumer confidence survey conducted by the RBI in 13 major cities indicated a surprisingly mild improvement in the urban consumer sentiments from the all-time low recorded in the previous round. Moreover, at 52.3 in November 2020, the current situation index remained much lower than the pre-pandemic levels. We now have the volume trends for a fair number of sectors for October-November 2020 to help us gauge the performance in the ongoing quarter. As many as 10 of the 13 indicators that we have tracked, which are available on a monthly basis, have registered a YOY growth in this period relative to October-November 2019. Out of these, the growth in the generation of GST e-way bills, petrol consumption, and rail freight traffic during October-November 2020 seems to be fairly meaningful in our view in terms of the signal that it gives about a sustainable improvement in economic activity. In addition to these, some other indicators recorded a very healthy expansion in these 2 months as compared to October-November of 2019. These are the output of Coal India Limited, passenger vehicles, scooters, and motorcycles, as well as electricity generation. But the high growth in this period has come on the back of a sharp contraction in October-November 2019. And therefore, it's not very convincing in terms of what it tells us about the sustainability of the growth momentum going forward. However, three indicators, which are vehicle registrations, consumption of diesel, and ATF, contracted in October-November 2020 on a YOY basis. The degrowth in ATF consumption remained fairly deep even during the festive season. And this just serves as a reminder that the contact-intensive parts of the economy will remain under stress until a COVID-19 vaccine becomes widely available. Secondly, diesel consumption displayed a marginal YOY decline. We think that this may be linked more to less usage of public transport and better availability of grid power, because other data on things like toll collections as well as the road freight index is actually quite encouraging. But the 20% contraction in vehicle registrations in October-November 2020 has come as a negative surprise, given the healthy sales during the festive season by itself. What this suggests is that the spending during the festive season was driven by pent-up demand, and that consumption is yet to fully stabilize in various sectors. Moreover, 6 out of the 13 indicators that we track reported lower volumes in October-November 2020 relative to October-November 2018. This indicates that a full economic recovery is somewhat distant. This brings me to my first polling question of the day. When do you expect your business to be back to pre-COVID volumes? Already back during the festive season, followed by a temporary dip, Q4 FY21, Q1 FY22, Q2 FY22 or later. The polling questions should have popped up on your screens. I invite you to please take the next minute to respond to this question. So I now have the results of our first poll, and it is a very mixed audience. 16% of our audience says that business is back to pre-COVID levels already, but 25% each have said that they expect business to be back to the pre-pandemic levels in Q4 of FY21 or Q1 of FY22. And as many as 34% of you think that it's going to be Q2 FY22 or later. This is very interesting because I didn't expect that the highest response was going to come for the last period that we had indicated over here, and that only 16% of our audience feel that business is already back to pre-pandemic levels. So I think this is certainly telling us that the recovery is going to be protracted. It's not going to be a very sharp or a very quick recovery in all sectors, and it's of course going to be fairly uneven. I think that's something that we all do expect. So now I'm going to move on to some available data for December of 2020. This, I must say, is cautiously optimistic. The growth in electricity demand, as you can see on the top left chart, has risen modestly to 5.1% in December 1 to 17, 2020, from 3.5% in the previous month. The next chart shows you that the growth in rail freight traffic rose to 9.6% in the first 10 days of December from 9% in November of 2020. And these remain really fairly robust numbers. So quite an encouraging signal of the level of activity which is happening on the ground. Also, in the first 18 days of December, vehicle registrations already stood at 2/3 of the level in December of 2019. So this tells us that the recovery is protracted. E-way bills isn't quite encouraging. The level has dipped a little bit if we look at the daily average for the first 13 days of December to 1.77 billion. And in the comparable similar period of the previous 3 months, it had ranged between 1.8 to 1.93 million per day. So this dip that we're seeing in the current month may reflect a satiation of pent-up demand, as well as production disruptions in some states because of the reappearance of the supply chain issues that we are seeing in some sectors. So to quickly summarize, volumes are recording a mixed but tentative recovery in Q3 of FY21. However, the tailwinds of low commodity prices are turning into headwinds as the visibility of vaccine availability is now pushing up global commodity prices. Moreover, some companies have started to enhance salaries, lifting the freeze that had been instituted during the pandemic. This brings me to our next polling question, which is, have you started to experience a rise in hiring, salaries, raw material costs? Please check all of the options which are applicable. I now have the results of the third poll. The second poll, an overwhelming majority of you, 73%, have already started to see raw material costs going up. 44% of you saying that hiring has already restarted. That's a good sign. That means that business optimism is rising, and at least there is some visibility of a recovery in almost half of your businesses. And 18% of you also said the salaries have started going up. And I think this is something that we do need to keep in mind as we look at profitability in particular going forward. Now we'll do a quick check of the agricultural sector. The overall rainfall in the post monsoon months in 2020 has been normal, but with geographic and temporal unevenness. On a pan India basis, reservoir storage is now somewhat lower than it was in FY20, but it remains at or above the peaks reported in FY16 to FY19, and that's really quite encouraging. 85% of last year's Rabi acreage has already been covered as on the 18th of December. On a YOY basis, acreage is now about 5% higher than it was last year. But given a huge base of the previous fiscal, we don't think that the Rabi season will end with an increase in sowing of more than 1 to 2% over the level at the end of the Rabi season last year. Nevertheless, with early sowing and healthy groundwater and reservoir levels, we do expect the gross value added growth of agriculture, forestry, and fishing to ease only marginally to 3.3% in the second half of this fiscal year, from 3.4% in H1 of FY21, in spite of an unfavorable base. So, while agricultural growth would remain steady, rising raw material and wage costs would partly counteract the impact of higher volumes on profitability in many of the non agricultural sectors. With a lagged recovery in the contact intensive parts of the services sector, we forecast a small contraction of 1% in the Indian GDP in real terms in Q3 of FY21. This implies that the recession is yet to end in our view. Looking ahead, a bright outlook for Rabi output, along with the MSP increase and healthy procurement, should sustain farm demand. With labor migrating back to the urban areas and hiring restarting, remittances will also restart, supporting the non farm demand in the rural areas. Moreover, urban consumer sentiment is expected to improve, along with the economic revival and greater visibility of a vaccine availability in the coming year. Nevertheless, we do expect unevenness to persist across consumption categories in the coming months. Moving on to exports, they've seen a temporary dip in Q3 with the reimposition of lockdowns and restrictions in various trading partners. We expect exports to revive modestly in Q4 of FY21 as the vaccine rollout gathers traction in the major trading partners. Also, there's been a fairly good improvement in the visibility of tax revenues. We've seen the data that's being reported for direct taxes for Government of India, and it is fairly encouraging, even though it benefits from a low base. But overall, an improved visibility of tax revenues should boost the spending of the Government of India in the remainder of this fiscal year. At ICRA, we have estimated the Government of India's total expenditure, excluding recovery of loans, at about 14 trillion in November to March of FY21. This is almost 34% higher than the level that was level of outgo in the last 5 months of FY20. And if spending of this order materializes, it should provide a fair boost to economic activity in the remainder of this fiscal. Improving tax inflows during the festive season also seem to have eased the pressure on state government borrowings in the ongoing month. The gross amount raised through state development loans between December 1 to 15, 2020 contracted by 8.2% in YOY terms after the 48% expansion that was seen in the period from April to November of 2020. But anecdotal evidence on state-wise capex reveals mixed trends, and we expect the pace of expenditure to be fairly uneven across the different states in the remainder of this fiscal year. We also remain cautious that an impending large adjustment in central tax devolution could cause expenditure strains to re-emerge in Q4 of FY21. Although business sentiment has improved, we expect a broad-based pickup in investment activity by the private sector to be ended until the second half of the next fiscal, after the COVID-19 rollout, vaccine rollout becomes fairly widespread, and there is greater clarity regarding the domestic and the global growth outlook. So on balance, we expect the recession to end next quarter with a muted 1.3% growth in Q4 of FY21. With this, we expect the contraction in Indian GDP in FY21 to be limited to 7.8%. This brings me to an end of my slides. I will now ask Mr. Indranil Pan to please share his views. Indranil has been the group chief economist at IDFC First Bank since 2015. Prior to this, he was chief economist at Kotak Mahindra Bank, where he worked for 14 years. He also served as an economist at CRISIL Limited and as a principal correspondent at Business India. I now invite Mr. Pan to please share his remarks. Indranil, you're on mute.
Thanks, Aditi, for this great presentation. The way I would want to take this forward is not in terms of number, but more probably in terms of logic. Now, for economists, it has actually quite become a fashionable job in terms of trying to predict a GDP number. Anyways, in normal times, we as economists have horribly failed predicting GDP numbers. And here we are sitting in absolute abnormal times, trying to take some assumptions. What I believe is hanging on a very thin line of the vaccine. And very unfortunately, I myself am not a great believer of vaccines immediately, given the fact that various other regions of the world are seeing their second waves and the third waves. In India, we have just finished the first wave, and yet we have not really even authorized a commercial production of the vaccine. Now, having said that, we all have started reading about the new strain of virus in the UK, which, without sort of painting a very sort of downsized picture on the global economy, I think is a factor that needs to be concerning, needs to be worried about. In fact, the Indian authorities have actually stopped now all flights coming from UK till about 31st December, pending further sort of direction. As I said, I'll go beyond the numbers. It's whether it is a negative 7.8 or a negative 8 or whatever it is for the current financial year. My objective here is to try and understand whether we have or likely to have seen a rather durable damage to the economy, which will actually take some time to rectify itself. Now, if we remember, before we entered into the pandemic, the quarter January, February, March of the last financial year, we had seen a growth of just 3.1% and a consumption growth in real terms just about at 2.7%. And I think the fear had started emerging thereon in terms of how the structure of the economy is acting as a huge bottleneck in terms of the future momentum for the economy. Now, here we have the pandemic. And here, after the pandemic, I actually am left struggling to figure out which comes first. Is it the investment demand as the government envisages it to be? And most of the policies are earmarked to be in terms of the Atmanirbhar package, in terms of all that they have basically been doing in terms of the reforms momentum through various packages that have announced? Or is it the consumption that needs to be the front line in terms of activating economic activity, and then only investments need to follow? The reason I say so is that even in the pre-pandemic phase, we had we had a capacity utilization level of just about 68 to 72%. Post-pandemic, what we see is that the capacity utilization has dropped to close to 50%. And even as some of the sort of jobs are coming back, and even as some of the capacities are coming back, the services sector continues to be in a problem. All the contact services seems to be in a severe sort of distress even at this point in time. And it is very difficult to understand how capacities will improve from here on. Now, the few points which sort of underlines these sort of assumptions of mine is the very fact that a lot of people continue to lose their jobs. We have actually sort of seen newspapers continue to be flooded with various sectors which have problem and they have lost their jobs. The latest is the Honda plant, which has shut down and which has had to go let go a significant number of employees out there. Yes, there have been certain sectors which have sort of made media headlines in terms of wages being restored, but I am not sure whether they will neutralize one another or whether the wage increase will be relatively better off for the system as a whole compared to the job losses that are happening. That is point number one. The point number two is that in a situation where there is significant surplus labor that we see, to a certain extent, people who have lost their jobs and who may have found an alternative, they are probably finding an alternative at a lower salary level. The third point is that given this, and given the fact that there has been job losses, and for people who understand the life cycle hypothesis, there is definitely a significant amount of precautionary savings that have happened in the economy, indicative clearly by the fact that your deposit growth, even at the very low rate of interest, is about 11.3% at this point in time. Point number four is, and something that one of the panel members of the MPC have already also highlighted, is the real hit that the savers are having to take at this point in time. Now, the MPC member did talk about this fact only in the context of the retiring people who are retired. But I think this is a problem even for people who may be in their job at this point in time, or maybe who are still in their working life but probably have lost their job. For them, at a 5% average sort of 1 year deposit rate with a 6.5% average inflation plus taxes to be paid on the interest accrued, I think everybody is suffering from a negative interest rate scenario at this point in time, which in India, in my opinion, is a significant issue because we don't have a clear social security net for ourselves. So now all these points taken together clearly tends to indicate that consumption is something that we might actually continue to struggle with for a significant period. And we might actually sort of endure a rather durable loss in the consumption for the next coming few months. The second, of course, is the supply chain, where I think things have still sort of not, even with all the policies of the Reserve Bank of India, for directed lending on the credit side and sort of trying to address the liquidity needs for the smallest of the entities. I think there are adequate anecdotal evidences to suggest that there are certain types of business, especially on the manufacturing side, the more indigenous manufacturing, small scale, who actually had to shut down in the current pandemic. So the problem that I face, therefore, is that there could be both a durable damage to the consumption. There could also have been a durable damage to the supply chain, which necessarily means that even as we start building up our GDP numbers on the basis of a base effect and some normalization, no doubt, I'm not sure whether in terms of the production possibility frontier, we will be very soon coming back to the levels that we were there even in the pre-pandemic days, which I had already indicated was anyways on a lower side. So that actually leads me to believe that even if the numbers turn positive for the growth, which it would, I'm not sure whether the pickup will be extremely strong enough. Now, in this sort of a scenario where the real growth may not be strong enough, I think what the Indian economy actually needs, and this may be a very debatable point, but I think what the Indian economy actually needs is a relatively higher inflation, which will not only help in terms of the government's calculation of the fiscal deficit because your denominator goes higher, it also leads to adequate generation of revenues, or at least some additional generation of revenues because your nominal GDP would be higher. And therefore, just by pointing out the fact that inflation is high in India doesn't really, at this point in time, actually helps much. So if I have to sort of lay out the table in terms of the arguments that I just positioned, I think I would definitely side with the participants in the first poll, who actually said that there is a much bigger chance that the recovery in the economy is more back-ended than being seen immediately, even as we sort of all realize that a negative 23.9% to a negative 7.5% definitely represents what we in English language call a V. But beyond this, the recovery, even as Aditi pointed out, is likely to be more flattened than anything else. So the important part here is, unfortunately, we need policies to really pump up. We need more the fiscal side to really pump up. But having understood that the debt GDP rate of the government will be closer to 90%, my fear is that whether there will be a need, given all the rating agency perspectives, etc., whether there will be a need for the government to actually become more tight-fisted in FY22, which in itself will have a damaging effect on the recovery process, purely from the point of view of the debt sustainability and the signaling to the market that they need to make in terms of the fiscal strategy, because very clearly the RBI can't stand tall at all points in time and expand its balance sheet beyond certain limits. So that, I think, is a real risk to the system. The other big risk to the system, in my opinion, is the banking sector. And I'm not sure as an economist or even otherwise, we have really understood the type of risks that the banking system holds for us, given the fact that most of the loans that were on moratorium, there has been no asset reclassifications that have happened. And when that happened, we really don't know what is the type of sort of NPAs that come on the table. So next year, we will, from a fiscal side, we will possibly also need to look at capital infusion from the government to the public sector banks. That is also likely to be on card. And how much they will be able to do it will obviously be dependent on the type of fiscal numbers that they will probably come up with. So our numbers for the next financial year, for the current financial year, is about 8.4% negative, which is slightly worse than Aditi's. But again, as I said, we are all doing number crunching. I don't know from where, and most of us will probably go wrong at this point in time. And for the next year, we are more closer to, in my mind, we have not really done the numbers very thoroughly yet, because it's very difficult to do the numbers. But purely from a base effect plus some normalization, I think broadly it should be around 6.5 to 7.5% for the next year. But my fear is that beyond the base effect, it might once again sort of future years normalize to around 5%, unless we really have a big push from the vaccine side and all the sort of pandemic related issues actually vanish from this world. I'll stop here and I'll hand it back over to Aditi. Thanks, Aditi.
Thanks, Randranil, for your remarks. That was very interesting, and I definitely agree with lots of points which you made. Just as a follow-up, our view right now that is shaping up for next year is a little more optimistic than yours. We think that GDP growth could benefiting from the base effect and normalization, as you put it, and maybe some fatigue and revenge buying as well, go up to around 8.2% in FY22. But we are also finalizing the numbers. Like you said, it's really a little too early to have a lot of conviction for a firm number for FY22. In terms of the budget, I agree with you. We need to wait and see how things pan out in terms of both Government of India and the states, what kind of spending is going to be allowed by the revenue visibility. But now that our audience has heard from two economists, I request the third poll to be put up on the screen. And here we don't have any numbers. We're just asking for a timeline. According to you, when will India exit the recession? In Q3 FY21, Q4 FY21, or Q1 of FY22? Please take a minute to respond to this poll, and I'll in the meantime, move on to introducing our next panelist, Mr. Bri Prasanna. He is the Group Head, Global Markets, Sales, Trading and Research at ICICI Bank Limited. He is responsible for economic research, trading, market making, and sales distribution of all treasury products related to fixed income, foreign exchange, and derivatives. He's also the chairman of ICICI Securities Primary Dealership. He is currently the vice chairman of FIMDA, additional vice chairman of FEDI, and director on the board of CCIL. Thank you, Prasanna sir, for joining our poll today. I'll just wait for our poll to close before I announce the results. I now have the results of the final poll. So most of you expect the recession is only going to end in Q1 of FY22. 52% of you think that that's when it's going to happen. 9% of you are optimistic that we're already out of the recession in Q3 of FY21. And 40% of you agree with me that we may get a small growth and get out of the recession in Q4 of FY21. So thank you to our audience for sharing their views. And I will now ask Prasanna to please share his views on the economy, markets, and liquidity.
Good evening to all of you. So at the outset, let me thank Aditi and ICRA for having me in this seminar. So I was first of all actually intrigued by the fact that we have a 1 hour panel, but we have only 2 panelists with 1 moderator. So wasn't it better to have more views by getting more economists in the panel? That was my first reaction. And when I asked this to Aditi, she was actually frank enough to say, that's okay, sir, but we have one treasury head in you. And we all know how you can give 2 opposing views at the same time. And so that actually her response got me seriously wondering about my reputation in the market. But on a more serious note, I should actually thank her for giving me a free hand to kind of speak anything that I want in the opening speech. And what I choose to speak is I will try and marry the economy and the markets, which seem to be diverging a lot at this particular point of time. In fact, I think the estimates given by both Aditi and Indranil are kind of at the lower end of the spectrum, and markets are actually running much ahead of what the expectations of the economists are. So 2020 is kind of a year which we can call as the year of, let's say, the dichotomy, because there is seeming dichotomy in markets and economy, between hope and despair, between traders and economists, between central bank actions and the private sector investments, between market leaders in each industry and the rest of the participants in the same industry, between the haves and the have-nots, and also the seeming dichotomy between developed market recovery and emerging market recovery. And lastly, as we close this year, there seems to be also a dichotomy which is developing now between the 2 V's, the most important 2 V's in the market, which is, or in the economy, which is vaccination versus the virus, with the possibility of the second wave that Indranil was alluding to, very much a real possibility in UK, Europe, and the US. So during the initial pandemic period, the variability in global macro forecast was really immense and uncertainty was at its peak. So as there was really no precedence and market had no clue on the possible course and the final outcome of the pandemic, there was actually a race to bottom in terms of predicting the future. And it was not only the macroeconomic variable, even asset class performance was getting all over the place. So however, there were a lot of excesses in terms of forecast, but as we moved along, it is also all these excesses were getting corrected to a large extent. And now with analysts having a reasonably clear line of sight, I mean, relatively clear line of sight, I should say. And as a result of this, within a period of 12 months, we have actually moved from utter despair to some bit of exuberance as far as the market is concerned. The consensus 2020 global GDP was expected to decline by around 4% and expected to grow by around 5.1% next year. And the 2021 GDP numbers are expected to further get revised upward from even this 5.1, with some leading research houses like Goldman and UBS even penciling as close as 6%. So when was the last time all of us, saw a global growth of this kind of a magnitude in a single calendar year? And of course, it's a different matter that there is a lot of base effect which is coming into play, and there was a huge fall in this year. But it is important to note that these global growth revisions are getting better and better as people revise it. And it is now as much as 3% higher than the initial estimates that were doing the round in the initial part of the year. Now, these changes and revisions are not limited to forecast on the economy. It is also on the global asset classes that I was alluding to. Gold, which was a perfect asset class during this uncertainty, actually started to lose some of its shine or some of its gold, so to speak, as the vaccine and the open up trade started to play out sometime in August onwards. Equity and other asset classes took over post July as the overall volatility index, the VIX index, also started to decline. So from the world of markets, which used to oscillate between risk on and risk off, we now started moving away from stay-at-home trade to unlock trade. Now, this shift in the global asset class performance, or the way the markets have, behaved, even as economists were predicting recessions, there are 3 very important reasons. And I'll define it as liquidity, liquidity, and liquidity. So in that order, if I can say. So the first liquidity is actually liquidity from central banks. The central bank balance sheets have actually increased manifold, with most of the countries actually, the central banks doing as much as 20 to 25% of GDP in terms of the liquidity that they have really added. For example, the US went from 20% of GDP to something like 38% in terms of their balance sheet size. Now, so this in the US alone, this kind of added around $3 trillion of liquidity, where the Fed's balance sheet moved from 4 trillion to 7 trillion in just 6 months. And you will remember that the Fed balance sheet was actually declining before COVID struck. And to put this in perspective, when the GFC crisis hit, which is the last known big crisis for all of us in our working life, when that hit, the Fed's balance sheet actually doubled. But in absolute terms, it was still an increase from 1 trillion to 2 trillion in the year of the crisis hitting us. So in absolute number terms, the kind of numbers we are talking about is absolutely mind-boggling. The second liquidity that I would talk about as a reason for the market performance is actually liquidity from the government in the form of the pump priming measures that they have done across various countries. Of course, India has not done anywhere near what the developed markets and other countries have done, but most of the fiscal measures are quite substantial. Germany has announced something close to 40% of GDP. Italy is close to 35%. UK is around 25%. US is around 15%. And as we speak, the bipartisan deal of $900 billion, which is likely to get the US Congress approval today, will also add another 4% of GDP. So that was the second liquidity. Now, in terms of the third liquidity, which I call the most important reason, is actually the liquidity of hope that things are getting better and will get better in the future. So you all know that markets are kind of the fastest data processors, and they keep spewing out verdicts by the second and by the minute, and keep processing the incremental data as it keeps coming. Now, hope is one important reason why they are now discounting the future data to say that things will get better. So when you really combine this huge wall of liquidity with this liquidity of hope, the result is what we have seen in this year, a huge rally in almost all the asset classes. So this, in a nutshell, is what is happening in the US, the global growth space. And what it also means is that there is a very strong view of the dollar weakening over the next year or so, because we are going to kind of see a global synchronized growth which is going to happen. And this assumes, of course, that the second wave does not hit us badly. I mean, this is the consensus view, maybe before this weekend, I should say, which is that everybody, all the countries actually grow well. And with this liquidity continuing for the next 1 year or 2 years, this liquidity will chase assets which are yielding high, which are will go into countries which are growing well, and hence will leave US to some extent and go into emerging market space. And that was also one of the reasons why emerging markets were doing very well, and India was also, getting a substantial amount of these inflows. So that is a global perspective. So we have actually heard before. I don't want to do a very detailed number on India. Like Indranil himself said, I will stay away from GDP forecasting. I know that we all can go wrong. So why, try and predict a number, though we do have a number. I'm not going to say that necessarily in this forum. But they have spoken a lot about the macro. So what I thought I'll speak about in a couple of minutes or in 3-4 minutes is about the qualitative nature of the behavioral aspect of what's happening, post-COVID. And I look at it from, 3 or 4 ways in which the economy, the various stakeholders in the economy has responded. First is from the perspective of pent-up demand versus actual demand. I think Aditi did make that point about pent-up demand. So I must admit that I'm a little bit more optimistic that we have actually now, in addition to the pent-up demand, there is definitely some kind of a recovery which is actually seen in actual demand, even from a normalized basis. I mean, she did talk about a lot of high frequency indicators, so I will not go into that. But the big question, according to me, is what has been the driver of this growth? And I would say, like I said, some of it could be pent-up demand for sure, but there is definitely, I think the pent-up demand part is more or less behind us. And what we are going to see going forward is to some extent a recovery in the cyclical demand. For example, if you were to take the auto sales number, the actual auto sales number for the month of November, there has been a softening of demand post the Diwali festival season, which always happens. The interesting thing is there are anecdotal evidences to say that the softening this year post festival is not as much as what the softening used to be in previous years. So there is definitely seems to be some extra kind of a demand which is definitely there. And also forget all the auto and the other things. You also, from the perspective that the work from home has necessitated various new categories which are witnessing significant growth. I mean, like for example, dishwashers, vacuum cleaners, home appliances, laptops, and so on and so forth. So that is the first aspect. The second aspect I wanted to quickly talk about is the kind of conclusion that you can derive from the way auto sales is happening, the telescoping of the demand, and the downtrading by the consumer. Consumers are gradually shifting one level lower. So by that, what I mean is, let's say there was a customer who would have otherwise bought a Merc is actually buying a Corolla today, or a Corolla customer could actually be buying a Honda City, and so on and so forth. So this is very interesting, also because of the fact that the various parts of the economy are witnessing different types of qualitative recovery and different types of qualitative behavior. The third aspect that I wanted to also talk about is something I think the earlier speakers referred to, is the seeming divide between the haves and the have-nots. It is unfortunately true that income inequality has probably actually tremendously increased in this pandemic year. The large-scale migration and also the loss of employment has actually impacted the lower strata of the population, while the middle-class individuals with stable income have had much lesser impact, or may even would have escaped unscathed, with the result that the super rich would have even possibly got even richer. So it's a complete inequality that has happened in the current year. And the interesting impact this has probably done on the economy is that the negative impact of the loss of consumption from the lower strata of the society has been more than offset by the vengeance buying by the middle class and the rich, who seem to have saved a lot on their regular expenses, like on travel, dining, petrol expenses, transport, and etc. So that is, I think, one important reason why we are probably had seen a reasonably good recovery, much better than what most of the economists expected in the initial part of the period. So these are some of the points that I wanted to talk about. A couple of other points, I don't want to elaborate on it because I'm losing time, is the fact that financial conditions are really at one of the lowest levels that you've ever seen. We have never seen interest rates at this level, and we have never seen liquidity surplus at this kind of level. So from this perspective, I think the financial condition index has eased so much. Low interest rates, I don't need to really explain the impact on housing loans and real estate. Many corporates, in addition, are today borrowing at lower than repo rate and giving them a substantial savings on interest costs. So lower interest rates and growth in salaries in the last decade, plus the fall in the real estate prices over the last 6 months or so, have actually made housing much more affordable today. Lower interest rates have also made equity investing an attractive proposition, and the rally in the equity markets have further eased, at least the rally till yesterday, has eased financial conditions substantially, adding to the wealth effect as well as to the capability of the corporates to raise risk capital and give them the confidence of handling a post-COVID scenario. So, and then, of course, I don't want to now talk about the PLI scheme, but I am a big fan of the way the PLI scheme has been, kind of introduced. And I definitely feel that that can make a difference to the CapEx revival as well as the aggregate demand prospects of the country a couple of years down the line. So the conclusion from my side is a lot of the recovery definitely was pent-up demand, but some of it is also a cyclical recovery, which is ironically being triggered by the biggest health crisis of the last 100 years. Now, it is quite possible that the lower end of the pyramid, like I alluded to earlier, where the job losses and the cut in earnings have been the worst for them, will possibly come back to bite us after some time. But the irony is that it might not show up as much as in the GDP numbers, as well as it might not show up in the earnings of the listed companies. So I would say that in a year from now, as a country, we might be worse off from a happiness index perspective, while the GDP numbers and the listed companies' earnings revival are possibly likely to do much better. So COVID has possibly exemplified or actually justified the criticism that GDP is possibly not the best measure of the overall economic health of a country. So with that opening statement, slightly longer statement, I apologize for that. I will turn this back to Aditi, maybe some of that some of the missed ones, we can actually address it in the Q&A section. Back to you, Aditi.
Thank you, sir. I agree with you that this is a year of materialism, not experiences. So totally agree with you on that. But I think our panel has given a fair diversity in our views and in our reading of the current economic situation and how things may pan out. For you, Prasanna sir, I have one follow-up question, which is how do you see the situation a few quarters down the road when the RBI finally starts to unwind this excess and this very large surplus in liquidity that we're seeing right now? Do you think that that is something that is going to derail the recovery that you're talking about? Or do you think that the recovery itself is going to absorb a large part of this liquidity surplus and leave us in a reasonable situation a few quarters down the road?
So I think, Aditi, after doing all the heavy lifting during the pandemic, it will be reasonably correct to kind of assume that RBI will be sanguine and kind of be careful in unwinding the liquidity. I think the governor's statement in the policy was mindful of that. And in fact, the minutes from what the governor said is mindful of that. I think we have some other members of the panel who are a little bit more, hawkish. But this theme about the recovery itself draining liquidity automatically is a kind of far-fetched thought, Aditi. I mean, some people think that banks are deploying money with RBI because credit growth is not there. But we'll have to understand that once primary liquidity is created by RBI, which could be either through the FX or domestic operations, it can only be drained by RBI. So yes, if the credit growth is higher, it will lead to a higher NDTL growth, which in turn will lead to higher CRR requirement for the system. But you have to understand that even if 1 lakh crore of liquidity will have to be drained by using the credit growth route, that will take nearly 25 lakh crores of credit growth and NDTL growth of the system, because the CRR is just 4% at the point of time. So to answer your question short, yes, RBI will be mindful of the liquidity which is there. They will not do anything to create an accident. They will do it slowly. And what they have spoken recently in the minutes as well as the governor's statements gives me the confidence that they're not possibly going to come and announce to the market saying, I'm going to bring liquidity back to normal and I'm going to suck it out. They'll probably do it by virtue of slow and steady action. And that action will take a little bit of time. Like the action could be in the form of maybe initially a CRR hike, and then it could be in the form of ad hoc reverse repo announcements, but they will be taking it out slowly. And yes, surplus of 10 lakh crores is not going to remain next year. It may probably dwindle down to much lower, but they will give enough time for the markets to kind of adjust. And the impact of this would be the curve, which is the shortest end of the curve will be the one which will get impacted by the maximum. So in other words, I would say the short end rates go up while the long end rates do not go up as much.
Thanks, sir. Indranil, I'll pose the same question to you. Your views on how the liquidity unwinding will take place over the next year. Indranil, you're on mute. And also, I request our audience to please start sending their questions in the question queue while we listen to Indranil's response.
Yeah, so I think it's a very difficult question to sort of answer. And I think Mr. Prasanna has already laid the grounds on this liquidity. The problem is that it's not only about the RBI, it's about central banking all over the world. And central banking all over the world, I think, is playing with disequilibrium levels at this point, in the sense that they are very clearly intervening in the markets to support market logistics and to prevent any upstart reactions in the market so that it derails most of the policy action that is happening. Now, to that extent, I think to a certain extent, I am slightly negative in terms of how the currency in India will behave in the next financial year. And I think Mr. Prasanna laid this out also during his initial comments. The worry that I have is that if India's growth doesn't really pick up in a very decent trajectory, and if the rest of the emerging markets, including emerging Asia, does relatively better, then there is a possible case in point whereby some of the flows that we are being blessed with at this point in time actually gets diverted to the rest of the world. Our exports don't pick up to the same extent that we would anticipate, while a reasonably higher commodity price cycle will actually hit us on the import side of the picture. So I'm slightly sort of negative in terms of how the currency markets would behave. And to that extent, if that happens, then the whole sort of function of the Reserve Bank of India in buying up currency is no longer there, which in itself will lead to some amount of unwinding of the liquidity. In terms of how and what it could have in terms of a reaction on the yield curve, definitely yes, the short-term rates will probably start inching higher. Today, we are more or less at the lower end, even below the lower end of the corridor, given the surplus liquidity that we have, and which the RBI today is quite comfortable about. But in a phase of tightening, they'll have to clearly bring this back more closer to the signaling rate, which is basically the repo rate. So that is definitely one reaction that will happen. But I'm not really very confident about the longer end not really jerking up also, simply because what I associate along with that is the very fact that the fiscal doesn't correct back to a 3.5% level, or even the borrowing program of the central government plus the state government taken together, which is currently estimated at about 20 or 21 trillion of rupees. That doesn't suddenly come back to a 10 to 12 trillion rupees as in the pre-COVID days, which necessarily means that in a situation where liquidity is crunching down, if the government continues to be a heavy borrower in the market, or a relatively heavy borrower in the market, that would also rather have an implication in terms of the longer rates going higher. So my view is that to a certain extent, the whole yield curve may be shifting out, may not be an absolute parallel movement. The short term obviously would be moving much a bigger way than the longer term, but definitely the longer term yields will actually have to sort of jerk up higher, in my opinion.
So Aditi, let me just quickly agree with Indranil. Actually, when I said short end going up more and long end maybe not going up, it also assumes that the Reserve Bank will try to protect the long end from going up. Obviously, if they are not able to do it, like for example, I actually pencil in an Operation Twist kind of a program next year as well, where they will try and ensure that the 10-year yield does not go up. Because see, at the end of the day, you need the corporate sector revival to also happen. So the overhang of the short end yields falling so much, hopefully they will feel should not be felt on the long end, and hence they will try to come and intervene. But absolutely, Indranil is bang on. If the fiscal does not come back to normalcy, and if RBI is off, then it will not be a parallel shift, but it will be definitely a bearish steepening of the curve.
Let me just get your quick views on where do you see the fiscal deficit and the borrowing next year? I mean, what are your early expectations from what the budget for FY22 is going to bring to us on Feb 1st? Indranil?
I think previous budgets, my experience has been they have gone horribly wrong on the revenue side of the picture. It's not really the expenditure side which is leading to a 7.5 or a 7.8 fiscal deficit GDP. It is more the revenue side which they have actually misfired in a very significant way. Now, I'm not really sure how one needs to look at it. If the government wants to show to the world that we are on a course, or we are trying very hard to contain the fiscal, then once again you might have a situation where the revenue side of the picture can actually see some bullish overtones in terms of the expectations that they put out. As I said, it's once again very critical in terms of how much of inflation that we allow in the system. To that extent, I will be looking forward to the next target range for the Reserve Bank of India. And I would be sort of hesitant to really pin the Reserve Bank of India down in terms of trying to tighten monetary policy just about to bring inflation down. So the point again that I'm trying to make is that today we shouldn't look at inflation being one of the worst things. It is likely one of the relatively better things to look at if I'm looking at it from the point of view of the fiscal deficit, and from the point of view in terms of how much of revenues that the government can actually sort of garner. So my bet is that they will probably be looking at about a 5% as a proportion of GDP as a reaction of both the denominator getting better, plus some bullishness or plus some robustness that they would want to show in terms of the revenue stream. Obviously, the other point to note is that some of the disinvestments that they had planned in the current financial year, which amounted to 2.1 trillion in totality, some of that may also get shifted to the next financial year, which will also sort of remain a positive for the fiscal.
So, Indraneel, I think I broadly agree with lots of the points you made. We are also expecting that this year we're going to close with a fiscal deficit of about 7.7% of GDP. The entire hit is on the revenue side. We expect expenditures actually going to be pretty flat over the budgeted level. Despite all the fiscal stimulus that has been announced, we don't expect it to cross the budgeted level, but be able to get to it. And we expect there to be a large revenue shock on the tax, non-tax, and on the disinvestment side. Totally agree. Disinvestment will spill over to next year. We think that there's more likely to be a range for the fiscal deficit next year with a midpoint of around 5% of GDP for the government of India and maybe 3.5% of GSDP for the state. So that's broadly the kind of fiscal midpoints that we are looking at for FY22. So Prasanna, I now ask you to come in on what your budget expectations are.
So I'll be quick about it. So I think I heard Indraneel as well as you both say 5%. So I didn't have a scientific this thing, but we were looking at something around 5%. The thing about fiscal deficit prediction is that it's not an actual prediction. It's a prediction about what they are going to predict. So to some extent, it's a double guessing or a triple guessing, if you may. And yes, Indraneel was right in the sense that tax revenues always falter, but nothing prevents them from aggressively expecting tax revenues again. And they might be justified in aggressively expecting with economy growing and expectations of economy growing, so to speak. So I would say around 5%, and I would say gross borrowing number in the region of around 10 to 10.5 lakh crores.
I will now run through the questions we have from our audience, and some of them I think both of you have already addressed. So I will try to move to the ones that we haven't talked about very much so far. One of the questions we have is, how much do you think the push on capital expenditure by PSUs by the government can work for raising investment demand in the country? Prasanna, would you like to go first on that, please?
Yeah, Aditi. So I think that's a good move, and the government, that used to happen even when the government didn't have its own finances, and they were using the PSUs to try and do some capex. But in a scenario like this, when there seems to be animal spirits coming back, okay, so I have a markets angle, so I'm probably seeing that more than the economists like you and Indraneel. But I think there is some level of animal spirits which is coming back, and I have heard a lot of companies actually announcing greenfield and brownfield projects in the last 1 or 2 months, which means basically they are expecting the commodity cycle to stay where it is, or maybe get better as we go forward, better as in prices higher, and hence some of the guys are actually going ahead and investing. In this scenario, if the government were to use the PSU balance sheets to do it, I think it definitely makes sense. In fact, in the second half of this year, since the government saved up a lot on the first half, I do expect the government to directly do a lot of government spending in the second half, as well as use PSUs to drive capex plans.
One more question for you, Prasanna. How do you read the current investment cycle and liquidity stimulus package versus 2008-9? If you want to add any comments on that.
I would actually say that, no, I wouldn't really compare it with 2008-9. I would more compare the liquidity situation with the demonetization time, because there was a huge amount of liquidity which came into the banks and the mutual funds. But unfortunately, they all went out very soon. And the banks and the mutual funds who had invested in longer term papers, committed themselves for longer term money with the liquidity, actually had to face the brunt when the liquidity went out. This time around, it might be slightly different, though the risks are still there, that the liquidity which has come in will be taken out by RBI and not, the system as such. And you need to, track the inflation as well as what's happening in the global scenario and all, so on and so forth. So from a 2008-9 perspective, I think the comparison just, see, that was a Wall Street problem which went into real street. Now we have a health problem, and all the economy is getting affected. So I would say that this is not anything like we have seen before. It's a bit of demon, bit of global financial crisis, bit of World War type of situation, bit of the Spanish flu of 1920s. So I guess it's a bit of everything. And we need to analyze it with a different lens.
Thanks. Indraneer, I'll push the next two questions to you. One is on the domestic numbers. What is your expectation on credit growth in calendar year 2021? And the next question is a global question. How do you see other countries recovering from the recession, China, USA, and how will this impact the Indian economy?
Well, I think it's easier to take the second question first. Now, obviously, we have talked about the second round of infection, probably the third round of infection in the US. So that is something that really needs to be taken into consideration. As I also pointed out, I'm not really sure about how the vaccine is moving because we hear very diverse informations about the vaccine being successful, efficiency being at 95%, but there are certain sort of news reports that have come up in terms of the side effects of the vaccine. So everything taken together, plus the new strain of virus that is there in the UK, and we have taken a front guard action in terms of trying to prevent that strain of virus to come into the country. So having said that, I think the recovery very clearly sort of hinges on the success of the vaccine at this point in time, in my opinion. Yes, the Reserve Bank in any country and the government in any country, the whole machinery is geared towards providing the floor. But I really doubt whether that floor can be translated into a significant sustaining uptake unless the vaccine finds a huge amount of success and unless we as consumers are able to move out in a very significant way. So to that extent, in fact, I actually doubt some of the data that we see and sort of regularly analyze in terms of Google mobility. Just taking my car out and driving for 5 kilometers just because the car had been sitting idle at home for 5 days doesn't really show any productivity added by that mobility. So these are some of the things that we do look at. These are some of the things that we do sort of tend to push out. And on similar veins, I think there has to be a lot of caution that I would build up in terms of how the global numbers will pan out from here on. And there is quite a chance that most of the upside push that the numbers have seen from multilateral agencies and various other agencies might actually be at a risk, and we might not see such a significant uptick. Now, given this, obviously the export side of the picture for India remains a problem. The problem also is that let's remember that India has raised its tariff in a very significant way, which in my opinion is also likely to affect the competitiveness of the exports rather than just the external demand for the commodities from India. So I'm not really hopeful about India participating in any upside numbers for the globe through its exports channel. It has to be more domestic oriented in terms of how India really needs to sort of look at it. And the last point is obviously India is not in the RCEP at this point in time. So we need to understand the big daddy in the RCEP is actually China, and to what extent China actually sort of tries to prevent imports from coming into India or exports from China into India. What is the reaction of that in terms of the very critical inputs that get out of China will possibly impact the competitiveness in which we can price the output that goes out of India or the re-exports that we can do out of India. So that I think is on the global front. What was the other question? I've by now forgotten about it.
The other question, just a second. Think we've got lots of the other question I had posed to you was the credit growth for calendar year 2020.
Yeah, the credit growth for calendar year, obviously I don't think significant upticks are possible. I think we should be within this 5.5 to 6% band till the end of the year. More to do with risk aversion from the banking sector and also coupled with the fact that the demand for loans, just because the housing loan rate has come down, in an atmosphere where these sentiments are still not sort of awake to the reality in terms of future projections of my own income, may not allow me to buy a house immediately. So I think, yes, there will be some amount of movement. We definitely have seen the floor in terms of the interest rate cycle in India. But in terms of how much it can sort of build up towards the upside, we'll have to see. So credit growth for this financial year is likely to be quite weak.
One more question for you before I go back to Prasanna. With persistently rising core inflation, what are your views on the inflation risks and options for the RBI?
As I said, I think in terms of the inflation risk, yes, so long as it doesn't manifest itself into a hyperinflation, I think we should agree to the fact that an inflation in the range of 5 to 6% may actually be beneficial for India in the current scenario. As I talked about, a boost to the nominal GDP, that having its implication for the fiscal, both directly and indirectly through the tax side. So all those things are definitely there. The other issue, of course, is that the main target for the task for the RBI is to contain the hyperinflation sort of a scenario, which, if I read the Monetary Policy Committee, the various comments that come out, they are relatively hopeful that it will come down because the supply side impact will actually be, as the economy opens up, the supply side will relatively get better, while the demand side may probably still take a little bit of time to catch up. And that in itself can actually bring down your inflation to a certain extent. Now, having said that, we still, of course, have to understand what is the strength of recovery globally and what it does to the global commodity prices, including that of oil. The other thing domestically I have to look at is telecom prices, because I'm sure in the current situation, most of the telecom companies would be looking towards increase the telecom tariff, which is anyways the weakest in the world over. So some amount of adjustments there could also sort of push up my core inflation to a certain extent.
Thanks, Vendranil. The next question is specifically for Prasanna. Is the asset class pain indicated by NBFCs and banks optimistic, and should one be more cautious as things unwind?
No, I don't think I got the question correctly. Can you repeat that?
The question is the asset class pain indicated by NBFCs and banks optimistic, and should one be more cautious as things unwind?
Is the asset class pain indicated by NBFC and banks means what? I didn't get the point at all.
I think my understanding is that the question is that are the recoveries and the kind of NPLs that banks and NBFCs are projecting right now, are the levels too low, and should we be looking at much higher, worse levels for banks over the next few months?
I think in this perspective, it's very kind of difficult to guess, because it's a moving average kind of a thing. And as economy grows and as our clients, come back and talk to us, we still have to figure out how the collection efficiency is. But I can speak on the industry and not as a representative of our bank. And I can just say that right now, yes, the quality of lending that you have done is, even on the retail side, let's say to the salaried and to the people who are, so-called middle or upper class of the pyramid that I was talking about in my opening speech, then I don't think there is anything to fear, or there is not as much to fear. Because I don't think, people like you and me and people like all of us, we still retain a job and we still, have something to look forward to. It's really the lower end of the spectrum where people have really lost jobs and have taken a cut in their income. So I think, it's a very difficult question. I don't think I can give you a straight answer for that. I think only time will tell, because there could be some NBFCs and some banks which are possibly concentrated in the not so prime borrowers who might get affected. But at an overall systemic level, I do feel that it's not something that is underestimated at this point of time.
I'll push a couple of more questions to you. Will infrastructure be a key focus area of center and state governments to drive recovery in the Indian economy? Well, I certainly think so. I think that in addition to health and fully providing for the vaccine availability, infrastructure absolutely must be prioritized by the government in the budget next year. Prasanna, please, your views on that, and also your views on the government meeting its divestment targets for this year. That's the specific question.
So the government meeting the divestment target is obviously, I think, like you were alluding to, or I think Indranil did speak about it, they will most likely to do it in the next year. With the markets being where it is, and if it were to continue, I think they will do a good job of meeting the target in the next year. And I think they should also not be try to do everything in a very short span of time, because that has its own implications on markets. So I think they are thinking in terms of a privatization policy, which I think might come out, the detailed policy might come out in the budget, and that will give them a lot more degrees of freedom to play around with the various companies that the government owns. Now, what was the first is on infrastructure, right? Yeah, so that's a no-brainer actually, because the multiplier for infrastructure is going to be the highest. It has its repercussions on a whole lot of industries. So I think the government will do it. They will encourage a lot more of public-private partnerships to get their job done. Like you had alluded to, they would also use it, or somebody else had asked the question about public sector companies being used for infrastructure. That will also be done. So I think, and road projects, we know at the hectic speed at which NHAI is sanctioning road projects right now. So I think the infrastructure growth is a given. The only problem always was where to find the money. And if they do more and more of PPP kind of partnerships, and then I think that's clearly the way that they'll go ahead with.
And you think there's enough appetite from the private sector for PPPs in sectors other than roads?
No, I think they will have to sweeten it up a little bit, and I'm sure they will try to, attract funds from abroad, which is currently right now we seem to be in a sweet spot, and everybody wants to have a pie of the Indian growth story, and especially because interest rates are so low that they're all searching for. So, I mean, if a lot of projects become viable the minute you start putting much low interest rates, right? I mean, from a cash flow sheet where you're 14%, now suddenly if you start putting 8%, projects become much more viable. So my hope is that there will be much more but the government is surely focusing on a lot of reforms, and their common retort has been that they don't want to do reforms when they are having one leg on the brake, which is what was happening when we were in lockdown and when we were doing social distancing. And now is the right time for them to, of course, subject to the second wave not getting bigger and all that. Now is the right time for them to, pump prime through these kind of performance guarantees, as well as through some kind of making it more attractive for the private sector to come in. I think they'll do that.
No, I agree with you. I've been saying this for years that if financing weren't a problem, India would be able to get double-digit growth for several decades with the kind of infrastructure needs which are there in many sectors and in many states. So totally agree with you on that one. But unfortunately, it is financing which often ends up being the bottleneck. I'll take one question back to Indraneel, since you've been talking about India in the world and you also talked about RCEP, etc. Do you think the focus on domestic manufacturing and initiatives like Atmanirbhar Bharat will affect economic growth supported by trade, exports, and imports?
As I said, Atmanirbhar Bharat is a strategy for the longer term. And what I clearly indicated is that it's very difficult to highlight which comes first in the current juncture. We have always believed that investments has to forerun the consumption. That is, the current chief economic advisor had clearly been laying it down in its economic survey reports also. But the type of the crisis is such that with a 50% capacity utilization for the industry, you can't, even at lower interest rates, you possibly can't sit tight and expect that the industry will come and pick up money from the banking sector and invest. So it has to be, to a certain extent, a cyclical push has to be provided from the consumption perspective, which obviously the government alone cannot do it. It has to be a lot to do with the sentiments. And the sentiments, in my opinion, is now very clearly linked to the success of the vaccine. And that's where we are, unfortunately. So whether it is investments or whether it is consumption, I think it has to be a mix of the two, no doubt. But the first flag bearer, in my opinion, in the current situation has to be consumption rather than investments. Obviously, as Mr. Prasanna rightly pointed out, infrastructure is a big area, and my belief is that it is the government. Government has a big role cut out for itself. Now, if you really look at the various packages that the government has put out, obviously it has provided for a lot of enablers for investments to come in, infrastructure to happen from the private sector, but the government has to bring in the first buck for infrastructure, and then only a crowding in is expected from the private sector. The private sector left to itself possibly will not be able to, or will not be keen to, in the current atmosphere, be forthcoming with a lot of investments at this point in time.
Okay, I have one last question in my question queue right now, which is for Prasanna. Do you think India weightage can go up gradually in the coming years versus China in terms of investment by global funds? Also, your view on currency in USD INR will be helpful.
So on the view on the currency in INR, I think I had already said that the dollar index is going to weaken. That's the base case view that we have. But it has not led to any significant weakening in the rupee because the RBI has just intervened and picked up reserves like anything. Now, whether that will change going forward or not, only our governor can tell. And based on the fact that the US has already put us on the watch list, maybe is that going to lead to some kind of a change in the behavior by the RBI? We really don't know. But I really, feel for the governor, because we do. I mean, our intervention is based on RER, and we have a current account deficit, a fundamental current account deficit. But the US doesn't have current account deficit as one of the reasons as to justification of intervention in the market. So I would say that the dollar rupee would possibly trade in a 72 to 74 kind of a range. Not, I mean, this is if the, if the second wave were to become bigger, then all the bets are off. So right now, I'm assuming that it's not something that is going to really harm the people, and we will be able to have it under control. 72 to 74, dollar weakening bias, but rupee does not appreciate too much, plainly because RBI is there intervening. If RBI was not there, I would expect it to go to even 70, 71 levels. Now, on the, what was the other question? First question, or dollar rupee plus something else you asked?
The second question was the weightage of India going up gradually versus China.
So I think our weightage will go up, but against China, I'm not too sure, because China is also doing a lot of things right as far as their financial markets are concerned, and they are getting included in the bond indices and all that, and they have garnered a huge amount of flow this year. So I don't think we'll be able to compete with China in terms of attracting flows. But if we do better than last year or better than 2 years ago, that is good enough for us. So I don't think we need to be comparing our fund flow with China. What is important is, I think Indranil also made that point, value chain getting converted. A lot of FDI investments are now, looking at India as a potential place where
very interesting discussions and enlightening views from both of you. Any last comments that both of you want to add?
No, we have spoken enough.
Indranil?
Yeah, same here. I think best of luck to India. And India has never been, in my opinion, a case of a sprint. It has always been the case of a marathon. And with the policies that we have seen, I believe that the marathon will be run. So let's not lose hope totally about India. It's a slightly longer term story that is going to evolve for India at this point in time. And I do hope that there is also adequate support that comes in through the rest of the world, especially the developed markets actually finding their feet in the current pandemic.
Thanks, Indranil, for your closing remarks. This brings us to the end of today's session. I thank both of you, Prasanna and Indranil, for your enlightening views, and many thanks to our audience for the participation today, so close to Christmas, for participating in our polls and for posing so many questions for our panelists to answer. Thank you all once again, and wishing you all a happier and a healthier 2021.